Great. Hello, everyone. Thank you for joining our webinar. We'll wait another minute or two for others to log in before we start. In the meantime, if you do want to go grab that glass of water or a very quick coffee, feel free to do so. But also just to highlight, you have the QR code on the screen here to download the latest report measuring transition, tracking technology transition in the Indian steel sector. Which forms the basis of our presentation and discussion today. So feel free to just scan that and get the report in the meantime. Okay, we have quite a few people who have joined already, so let's kick the session off. Once again, thank you for joining and welcome to our webinar, Measuring Transition, Tracking Technology Transition in the Indian Steel Sector, where we will explore the key findings of the Indian Steel Majors Integrated Report, covering expansion plans, climate targets, and trade exposure in India's steel sector, and what all of this means for investors, for policymakers, and of course, the steel industry. Before we kick it off, a brief introduction to us, in case you don't know us. Carbon Tracker is a sustainable finance think tank analyzing the impact of the energy transition on capital markets and the investment risks related to fossil fuels. Our work, including the Steel Series reports, is free to access and to download, of course, from our website, but also from the usual third-party investor platforms, a few of which you can see on the screen here. And then we are very excited that we are joined by our partners, Carbon Transition Analytics, who are the authors of our Steel Series reports. Carbon Transition Analytics is an independent evidence-based research house that provides deep dive analytics on high emitting sectors using a robust framework that integrates financial and climate metrics. Their team has extensive experience in assessing company level transition readiness and the cost of transition, and their research has supported several major investor initiatives globally. Great. So today's session, before we'll dive into it, will run for around 45 minutes. We'll begin with a brief overview of the context for India's steel sector, followed by a summary of the integrated report and how it builds on the 4 company-level studies that we've published on JSW Steel, on Tata Steel, on JSPL, and on AMNS. We'll go through the key findings, including target alignment, locked-in emissions, transition outlook, and exposure to CBAM. And we'll then share some questions for management designed to guide investor engagement, finishing with time for your questions. And to submit a question, please use the Q&A function. You'll find it at the bottom of the screen. And if possible, please also include your names in case we don't get to your question. The team can follow up with you afterwards. And again, the QR code on the screen that you see here is available for downloading the full synthesis report. But if you do have any further questions, you can also just reach out to us. And with that being said, for the speakers today, I realized I started talking without introducing myself. My name is Nicole Kozłowski. I'm the head of engagement here at Carbon Tracker and at the Tracker Group. And I'll be moderating today's session while presenting for you today is Carol Ferguson and Dr. Paul Griffin. Carol is the CEO and research director, and Paul is the head of research at Carbon Transition Analytics. And we're very excited to have them here. They both bring extensive experience in the steel sector and in financial analysis. So it's great to be collaborating with them. And I'll now hand over to Carol, who will start us off with this presentation and get into the content. Carol, over to you.
Thanks, Nicole, for the introduction. And thanks to all who've dialed in. The Indian economy is the fastest growing major economy, growing at around 6.5% to 7%, and building up a domestic steel capacity has been the cornerstone and is very much part of the Indian government's economic and development goals. Indian steel production mainly goes into domestic consumption. So you have the construction sector, which is made up of infrastructure and real estate, accounting for around 65% of domestic demand. The steel intensity, the consumption of steel, is still relatively low in India, measured looking at kilograms per capita. India stands at 100, and that compares to around 225 as a global average. When the Indian government set their national steel policy, they set a target for India to get to about 160 kilograms per capita. And that implied a significant growth in steel production capacity of around 300 million tons per annum by 2030. And currently, Indian steel capacity stands at around 200 million tons per annum and was about 148 in 2017. So a significant step up in capacity required to meet the goals of the Indian steel policymakers. The carbon intensity of steel in India is relatively high. It stands at 2.54 tons of CO2 per ton of crude steel, and that's very high compared to the global average of 1.92. The Ministry of Steel has set a target to lower this to 2.2 by 2030, but that's still relatively high. And there are a few reasons that drive this very high intensity. There's a very low level of scrap availability given the current level of development in India. And so scrap is not available for secondary production or even in use in primary production. And also there's a significant use of domestic coal, which is of relatively low quality and goes into steel-making routes using rotary kilns and induction furnaces, mainly used by SMEs, which have a very high carbon intensity. And alternatives like natural gas that can go into direct reduction for steel is very expensive at the moment in India and not always accessible. To sort of step up to this sort of significant requirement for production capacity, a number of the Indian steel majors have pursued the blast furnace, basic oxygen furnace route, mainly because of the much more favorable economics based on both CapEx and OpEx. And this makes the trajectory for production in Indian steel growth still quite intensive. The alternative of deploying greener steel routes such as hydrogen direct reduction face a viability gap of around 40%. Next slide, please. The report that we've published today, as Nicole mentioned, covers 4 of the Indian steel majors: JSW, Tata Steel, which are part of the Nifty 50, JSPL, and AMNS, the ArcelorMittal Nippon Steel joint venture. The report culminates the 4 reports we've published separately on all 4 companies, looking at the findings in the individual reports and comparing the results. The approach we've taken to assessing and measuring transition for these companies is very much a bottom-up approach. We use plant level data and location data in our analysis. And we've drawn on some of the very good analysis already done in India by institutions such as CEW and TERI in coming up with our analysis. Our framework that we used in our reports has 4 key areas that we look at. Target alignment, which looks at companies' short and long-term targets, the implied absolute emissions from these targets, and benchmarks it against a policy-based scenario that my colleague Paul Griffin will talk through in more detail. We also looked at locked-in emissions, again, looking at scenarios for both confirmed, so projects that are already in place or have passed FID, as well as announced capacity expansions, and look at how these capacity expansion plans test emissions boundaries set by company targets as well as policy scenarios. The transition outlook metric looks at the transition pathways available to companies based on where they are and the different technology options, the carbon emissions profile for these technology choices, as well as the cost of transition. And finally, we look at the value chain exposure, both upstream, looking at methane emissions, and also downstream, looking at where demand is for for production, focusing in on issues such as CBAM, as Nicole mentioned, export markets, as well as the opportunity to attract green premium. The main purpose of trying to come up with this assessment is to see how companies can come up with a credible transition plan to attract the transition finance they need to decarbonize. I'm now going to pass on to my colleague Paul to talk through our findings.
Thank you, Carol. So initially, I'm going to just talk over the sort of league table, if you will, how the companies ranked against one another after all of our metrics that we added up and weighted. So you see that first of all, we measure these things on an absolute basis. So even the best performer can be performing not terribly well from a risk perspective. As Carol mentioned, we have a benchmark and we relate things to real carbon constraints in the real world. So overall, none of the companies score above 60 out of 100, which suggests there is generally a high risk within the sector, and that's unsurprising. The best performer is JSW Steel. Key reason for this, they're highly engaged in low carbon technology development. They're the most advanced in terms of coverage of certain key technology measures and the rate of deployment within India, which I'll talk to more about later. So they scored well on transition outlook and attending to CBAM risk as well. They have plans specifically to respond to the penalty tariffs that would be imposed by the CBAM by building out capacity in direct reduction, starting with natural gas, but increasingly blending that with green hydrogen. Now, the worst performer is AMNS. Now, this is despite the fact that they too are also scoring quite well on sort of technology development, but their expansion into blast furnace basic oxygen furnace capacity in India is quite vast and exceeds their budget quite relatively soon. But they have, and I'll talk more to that in the locked-in emissions and also in their targets. They don't actually specify a target year for net zero. Unusually, so we had to assume 2070 for AMNS. The others score relatively well on that, but we'll talk about that in a moment. So next, please. Right, so first we had to set a policy benchmark because there wasn't one that really existed that wanted to reflect the trajectory that emissions would be expected to take in India under the policy environment there, because then we could use this as a sort of a key sectoral benchmark that we then allocate to the companies. And as Carol mentioned initially, India has a target for 300 megatons per annum of capacity of crude steel by 2030, which approximates to 255 megatons of steel produced. This was set by the National Steel Policy Package that was established in 2017. Next. Right, so there was also been some documentation around what is called Vision 2047 in India. And this is a slightly more aspirational target, but nonetheless, something like 500 megatons by 2047, which is the centenary year of India's independence. Next, please. So then we look at emissions intensity. So there is a lot of work being done in the Ministry of Steel in India. They've put out quite a significant report on looking at the sort of the portfolio of different policy measures and toolkits to sort of try to attend to emissions intensity. And they set the target in that report for 2030 of 2.2 tons of CO2 per ton of crude steel. And so next, please. Now, in the Vision 2047 document, 1.3 was, again, aspirational, but 1.3 was mentioned as a possible target for 2047. If you continue that trend to 2070, then that's because that's where India intends, through its NDC, become net zero, and the Ministry of Steel has also stated net zero in 2070 as well. Now, if you combine both of the production and the intensity together, you multiply the two quite simply, you get the absolute emissions curve that would result. And this is where we estimate the emissions carbon budget for the sector. Now, there's a significant increase in emissions over the near term to 2030. However, this with reducing intensity would peak in 2040. But nonetheless, at around, well over half a gigaton per annum of CO2. So compare that to the annual emissions globally of CO2, which is about 38 megatons. So it's not insignificant by any stretch, and this is only one sector in one country. So, and it's increasing rapidly. There should be, according to our calculations, currently the Indian steel sector in terms of carbon emissions accounts for 12% of the Indian economy. But because of its rate of expansion compared to the economy, it would be somewhere around 14% of India's CO2 in 2030. So it's a rising share of emissions within the country. So on an absolute scale of emissions, can't be ignored. Okay, next slide, please. So looking at the target alignment metric, you can see before you the sort of linear trends where we combine the near-term intensity targets of CO2 for each of the companies. All of them have 2030 targets, and all of them have net zero targets. So then we continue the trend on to net zero. This is what they look like, and this is how they compare to the sectoral trend as well in intensity. You'll note that three out of the four companies are quite ambitiously going for net zero by 2050. So it's 20 years ahead of the NDC and the sectoral target. And what we found actually is if you weight the targets of all these companies together, by the way, the four steel majors that we're looking at here would account for about half of the overall sector's capacity in 2030. So it's about half of the sector. So you include these and the remainder of the sector, then you get a weighted average target year of 2060. So then the question, one question could be, well, if this is the ambition of the companies, and you would want policy to be commensurate with corporate ambition to support it in the right way, should there be an increased ambition for policy? Should there potentially be an ambition to raise the to move forward the net zero target in India to 2060? That's one question. But in any case, what we found, Tata Steel, worst short-term performer because, first of all, they've missed multiple targets for intensity They had one in 2025 that they missed, and they were originally going for 1.8 by 2030. They've scaled them both back, and it's looking like 2.2, which is the minimum requirement by 2030. So have the weakest short-term target, but then have the strongest net zero target. So it's quite an ambitious change of direction for them. And then AMNS, worst performer in the long term, because despite good presentation in their climate action report and discussion over some of the levers that they're looking into, and as I mentioned, they are engaging in a lot of low CO2 targets technologies. They nonetheless didn't mention when their net zero year would be, which was an unfortunate omission, but it meant that we had to assume 2070 for AMNS. So they scored poorly in target alignment. Okay, next, please. Now, if we multiply the intensity paths of each of the companies by the company's stated capacity expansion targets. So each of these companies also have plans that they've announced and quoted to increase their production capacity, at least to 2030 or 2035. Then we combine them together and it provides an absolute path. And what you see in here is the allocation of the sectoral budget that we've given to the company. This is assuming that the company takes its share of the budget implied by the sector, which remember is out to 2070. So that's the policy budget. That's the grey. There's a range there because I provided a range in terms of slightly different market shares moving forward. And now the coloured lines are what the absolute path is implied by their own targets, the company target itself. So you'll see that AMNS is a lot closer to its sectoral budget, but all of the companies fall within their sectoral allocated budget in terms of what they're targeting. Okay, next slide, please. So then we looked at the locked-in emissions of all of these companies. So essentially adding up all of the emissions that would occur if their assets, present-day assets and assets in the pipeline, were to operate over their expected lifespan. But first, we wanted to ensure that if these emissions are all truly locked in, we need to understand whether or not, or how much of these emissions could actually be managed after the asset is deployed. So we did an assessment of a geospatial analysis of the location of these plants relative to potential carbon sinks. So these come in the form of either basalt formations, notably the Deccan Traps running through the centre of India. There are saline aquifers off the southeast and east coast of India and off the west coast as well, and oil and gas fields as well. And now what we found in our assessment is that overall the potential for capturing and storing CO2 on the ground in India is quite low because of a number of reasons relating to the size of some of these sinks, the timing that they could feasibly be accessed, and the location of them. So with the size of them, the earliest potential storage locations would be from West Coast oil and gas fields, the Category 1 oil and gas fields, which means they're still producing, but once depleted or close to depletion, they could feasibly use to store CO2. Unfortunately, well, according to an assessment by the Global CCS Institute anyway, the actual capacity of these sources is not large enough to provide enough storage for some of these plants. So it's too small. And then in the case of basalt formations, which provide a much larger theoretical capacity for storing CO2, well, these are typically over 400 kilometers away from steel mills, large steel mills in India. So there could be a significant cost implied with the transport of this CO2. That's if they become available. And then finally, with saline aquifers, There are some located on the east and southeast coast of India, closer to the steel belt. But on the basis of CEW research, which looked at these project scheduling timelines for these sorts of projects, it'd be unlikely that these could be accessible before 2050, after which time a significant amount of emissions would have entered the atmosphere. So looking at this locked-in emissions, as you can see here, these are the aggregate of projects of steel production projects among the 4 steel companies under different scenarios. And you can see here that there are different colors relating to different steel making routes, but it's dominated by the blast furnace basic oxygen furnace route. You can see there are benchmarks here, so you can see the aggregate of the company targets amounting to 5 gigatons of a carbon budget, and you can see the sector allocated envelope amounting to 10 to 11 gigatons over the period to 2070. So I'll explain the scenarios that we developed. So the CS refers to confirmed scenario. This is confirmed projects that have already that may be in the pipeline but have passed FID status, plus existing capacity, of course. And then AS would be announced scenario. So this includes that the confirmed projects, but also projects that either been announced by companies or we found evidence of intent to deploy, but have not reached the stage of FID. So slightly more speculative, but nonetheless are the intention of companies in terms of the evidence that we've discovered. And another things that blast furnaces, I should mention that they run for they run for continuously a new blast furnace for about 20 years. It's known as a campaign. And often a new blast furnace is deployed with the intention of relining it after that 20 years, which could add another 15 years. But we defined lock-in as including a reline or not including a reline, just to show the comparison. So when you put these together, first of all, the confirmed scenario suggests emissions that are well within the aggregate target sample, which would suggest it's not too late to change some plans. Although I should note that a project, just because it hasn't met FID status, doesn't mean it is nonetheless quite mature in its progress along gaining environmental clearance. The announced scenario, so I should say we included optimistic and pessimistic, and this was just where we determined that where there's uncertainty over what the technology would be from the announcement, it provides a measure of uncertainty, so we can check the boundaries there. But essentially what we found is that even if in an optimistic situation where we account for a slightly more optimistic assumption on uncertain technologies, with no relines, if you add up all the announced projects, amounts to 7 gigatons of CO2, which would far exceed the sample aggregate target budget by about 40%. Now, if you include one reline, if we assume that is the case for new blast furnaces, then the emissions amount to 11 gigatons, or on a pessimistic view, up to 12. And so this would exceed even the sector allocated budget to 2070. So what that suggests is that, sorry if you don't mind keeping to that for 1 second, is that the decisions made today could influence the achievability of India reaching its net zero target in 2070. It's that far out. And my second point, so if companies would wish to achieve their CO2 targets as well whilst maintaining market share, they really should deploy alternative means of producing crude steel, or else have to shut down blast furnaces prematurely. So it's generally showing. So next slide, just to check. Next, please, just to compare the companies. Tata Steel has the least lock-in risk because they have less in the way of expansion plans moving forward, less projects on aggregate. JSW Steel has a significant number of projects in the pipeline to expand blast furnace, base oxygen furnace capacity, but also other technologies. But they also start from a high base because they're already the largest producer. Now, the worst performer is AMNS because they start from quite a low base. In fact, they start with one integrated steel plant, which uses a relatively high share of natural gas. But their plans moving forward would shift them towards coal and predominantly blast furnace-based technologies, but also the largest increase in capacity over the period. And as such, they exceed their budget by the most as part of the overall sample. Okay, so next slide, please. So transition outlook, we did a survey of all the sort of key abatement technology areas that companies are involved in. And we assigned ratings on each technology area, which I won't go through each and every one, but what the ratings that we assigned to each lever were abatement potential and systemic lock-in risk. And next, please. Yeah, so each technology was scored on this basis, and the extent to which companies were involved in these technologies was also taken into account, and that gave us a sort of weighted average view of where companies stood in their abatement technology involvement, and JSW scored most highly. Typically, companies that emphasized what I call the essential technology triad of renewable power, hydrogen production capacity through electrolyzers, and direct reduction shaft furnaces, which can utilize up to 100% green hydrogen to produce steel, whereas although hydrogen can be injected into blast furnaces, there's a limit to how much you can use. So next, please. So we also we added up all the abatement technology investments plus all the other investments, the announced and confirmed projects that I showed before. And overall, the sample, as expected, most of the overall capital is aligned with what we categorize as high risk for the systemic lock-in. Next slide, next please. Between the companies, you can see here in this chart the carbon lock-in risk exposure, which is the sort of the proportion of their investments linked to high risk investments, but also the absolute scale of investment for each company. So Tata Steel comes up worst, but if you look at Tata as a group, including the European operations, they would score a lot more highly. AMNS, they're investing the most overall in an absolute sense, and most of that is directed towards what we've classified as high risk projects. JSW Steel also investing significant amounts in that area, but at the same time have the highest amount of investment in lower risk technologies. In particular, they're looking at up to 10 gigawatts of renewable power and a 10 megaton per annum site in Salav, India, which would be based on direct reduction technology, which could, in theory, use green hydrogen. So next slide. So on the value chain exposure, we looked at, so I won't have time to talk about the methane, but I'll talk in some detail about CBAM quickly. So basically, we assessed the exposure of these companies, their exports to the European Union on the basis of the penalties that they would face from the CBAM, which is measured against their embodied emissions and the products imported into the area. But there are free allowances, so it comes into force next year. But the free allowances phase out over the period to 2034, so their real exposure will increase over that period. And it could be as much as $75 per ton of CO2 in 2030, according to our estimation, and 150 in 2034. But the average intensity of the majors in 2030 is 2 tons of CO2 per ton of crude steel. So you can double the amount on a per steel basis in 2030, so $150. Now, the share of exports into India from India into the EU is about 10% among the companies. Next, please. So not a huge share because there's obviously a large domestic demand that is increasing, but nonetheless, it's a part of the national steel policy to increase exports, and there's more opportunity for higher value products exporting into the EU. Next, please. And of the companies here, you can see where their intensities are from the y-axis, and on the x-axis, you can see their fraction of their exports going to the EU. The size of the bubble is the volume of exports. So companies that are sort of a larger bubble and closer to the right-hand side are more exposed. But you see that these dashed lines here, they show that if some of these companies dedicate their exports from their lowest producing CO2 emitting processes, they could be able to export at a competitive intensity into the EU because the horizontal dash line there is the average EU intensity. So for JSW Steel, for example, their natural gas DRI site, Salav, would be about 1.3 tons of CO2 per ton of crude steel, which would reduce their exposure. Next, please. However, so this is how things look among the four. A point to make here is even with natural gas straight production, companies could still face in 2030 a $100 per ton of steel entering the EU. So this suggests that even though this is a positive move forward, it would be required to minimize the penalty. It'd be necessary for the companies to develop more along the lines of green hydrogen as well. So that's the sort of summary of the findings. I can pass over to Nicole now.
Great. Thanks a lot, Paul. And also to Carol for the presentation. As you can see, it's a really detailed analysis, and we'll share the link to the report again, also just to highlight that we do have individual company reports that are accompanied by the synthesis report. Before we move into probably a very quick Q&A, we just wanted to highlight a few key questions for management that investors can use when engaging with the companies that are covered in this report. I saw that there's one question in the Q&A that was asking what kind of influence can international investors have in steering steel majors towards net zero pathways? And our suggestion here would be to use these findings and engage with the companies on the back of them. We know that some investors are doing that already. A few examples are here, and these could be some of those questions. So for one, beyond your 2030 target, what CO2 intensity would you aim to have in 2040? How will your capacity expansion plans align with your net zero target? And when are additions to BF/BOF capacity expected to peak? What specific contingency plans have you put in place should storage of captured CO2 not become available? And then lastly, what average CO2 intensity do you anticipate for your Indian steel exports into the EU in 2030? And what share of your total Indian steel production will this cover? If you have any further questions on these, specifically around engagement, please do get in touch with us, and we'd be happy to help and go in a bit more detail. These are just some high-level guiding questions, but we can help with being a bit more specific for each of the different companies. So with that being said, I'll just maybe get Paul and Carol back on screen for a very quick Q&A. I know we're almost out of time, and great, I see all three of you, all two of you here. Maybe one question that we've received previously is on CCS as a mitigation tool. And Paul, Carol, a question would be, how much can these companies rely on CCS as a mitigation tool?
I'm going to let Paul take that because I think he's already
Yeah.
inferred that CCS is not much of an option.
Yeah, there's some extent to which it's feasible to. I mean, companies are already working on capturing CO2. That's only one part of the equation. It needs to be permanently stored to prevent from reaching the atmosphere. Key means to doing that would be geological storage, and it's the timing and uncertainty of that which is a sort of key factor here. So even for those companies that could, through their production sites, gain access to some of these sinks, the timing of them would be quite late, later on towards the period, and there wouldn't be much towards the period to 2070. But actually, there wouldn't, in fact, be much time before their own targets expire in the middle of the century for some of these companies, which they could apply the storage measure, by which time they would have already emitted a significant amount of their carbon budget, or may even have peaked their emissions. So CCS we would see as, not necessarily having no role to play, but rather than being seen as a reason to justify a build out in coal-based assets, it should more be seen as a measure to soften the residual emissions after the fact, when there is existing infrastructure later in the period that has to be dealt with.
Thanks, Paul. And then we're unfortunately almost out of time, but maybe just one more question on CBAM, because that's what you spoke about at the end. If you look at CBAM, how much do you think is it likely to influence capital allocation strategies?
I'm going to say that CBAM is definitely having an influence in India. I mean, obviously, as Paul has said, that exports into the EU are relatively small out of total production. But if any policy driver is going to drive capital allocation in the short and medium term, the CBAM is one policy that will make companies that are exporting into the EU look at alternative technologies that are less carbon intensive. Paul, I don't know whether you want to add to that.
Yeah, no, it's definitely something that the Indian steel majors are responding to. Specifically, JSW Steel as an example, as part of their announcement for their direct reduction plant in Salav. One of the reasons for doing so would be to respond directly to trying to minimize some of the tariffs implied by the CBAM. And that can have the incidental effect of bringing forward some of these capacity deployments in alternative routes for the companies, and in so doing, advance their own sort of like experience with these technology and reduction in the learning curves, and confirmation for themselves and the sector as a whole, in fact, that these approaches are feasible, and some uncertainties can be overcome.
Great, thank you both. And that brings us actually to the end of the Q&A. I saw there's quite a few more comments in the Q&A section. We'll make sure to get back to you via email after this call. And just wanted to say thank you specifically to Paul and Carol for walking us through the findings and through the analysis that you have done. And thank you to all of you for joining us today, for spending time with us. We'll be following up after the webinar with you, but if you are an investor and you want to directly discuss the findings in more detail, or explore how we can support your engagement with Indian steel companies, please do get in touch. We've shared the Indian Steel reports. We'll make sure to do that via email afterwards as well. And as I said, you can find all of that on our website. So thank you again for your time and for your participation. And we look forward to continuing the conversations beyond today's webinar. Thank you.
Thanks, Nicole.
Thank you.